Welcome to the Deep Dive, where we slice through the latest corporate updates and give you the essential takeaways fast.
Glad to be here.
Today, we're plunging into Premier Inc.'s fiscal Q4 and full year 2025 results. They just had their call earlier.
Right. Premier, ticker PINC, a big name in healthcare GPOs and performance improvement stuff.
Exactly. So our mission today, unpack their numbers, their strategy, and, get a feel for what they're seeing out there in the healthcare market.
Sounds good. There's definitely a lot happening with them.
Okay, let's start with the headlines. Q4 looked remarkably strong for Premier.
Yeah, it really did. They reported non-GAAP adjusted EPS of 0.43 cents.
Or even better, 0.46 cents if you pull out Contigo Health, that segment they're winding down.
Right, which either way significantly beat what the street was expecting.
And revenue, too.
Revenue also came in ahead.
Yeah.
Landed at $262.9 million. Adjusted EBITDA was solid, $68.9 million.
So not just a beat, but maybe signaling some stronger underlying momentum than people thought.
I think so.
Yeah.
But it's fascinating because the market didn't immediately love it.
Oh, really? What happened there?
Well, initially there was some, let's say, apprehension, maybe looking at the forward guidance closely. But as the day went on, sentiment really shifted. Shares rallied quite a bit by the close.
Okay. So investors sort of digested it all.
Yeah, it seemed like they ultimately focused on that strong core performance in Q4, the beat, and critically, the capital return story. That really seemed to win them over by the end.
Got it. A bit of a turnaround intraday then. And looking at the full year, FY25.
Just as robust, really. Total net revenue hit $986 million. That was above their own guidance midpoint.
And earnings per share.
Adjusted EPS, $1.54, also above the high end of their range. Shows consistency through the year.
And cash. Cash is always king.
Absolutely. Operating cash flow for FY25 was incredibly strong, $417.8 million.
Right.
And free cash flow at $180.5 million. Actually beat their internal expectations.
That's some serious cash generation.
It really is. And, that kind of cash flow, it lays the groundwork for the bigger story here, which is their strategic pivot.
Right. It fuels those changes. Okay, so you've hit on a critical point. Let's dig into that. Those headline numbers are strong. But how did the different parts of the business contribute? Where did the strength really come from?
Well, both segments played a role.
Yeah.
But the supply chain services segment, their core GPO business, showed impressive resilience. That was a key driver.
Okay.
So Q4 revenue there was actually down 8% year over year to $170 million. But, and this is the key part, it outperformed expectations.
So better than feared.
Exactly. Tells us the core GPO is incredibly robust. Strength came from better contract penetration with existing members, signing up new members too, which drove spending higher.
Makes sense.
And what's really interesting, gross administrative fees, that's the key metric for the GPO, grew over 3% for the full fiscal year.
Okay.
And the growth was strongest in Q4. Now, management thinks this growth will actually accelerate next year, maybe to around 4% in FY26.
Accelerating growth in the core business, that's significant.
It is. And it connects to something else. Those fee share headwinds people worried about.
Yeah.
From old contract renegotiations.
Right, where their take rate was getting squeezed a bit.
Exactly. That seems to be largely behind them now. He said less than 20% of those 2020 restructured contracts are left to deal with in FY26.
So that drag is almost gone.
Pretty much. Fee share should stabilize in the mid 60% range for FY26, then tick up to the high 60s after that. It really cleans up a big overhang on the story.
Okay, so the core GPO engine looks strong, stable, even accelerating slightly. Good signal. What about the other side? Performance services. That's consulting and software, right?
Correct. That segment saw a bigger year-over-year decline in Q4, down 20% to $92.9 million.
Okay.
But sequentially, the advisory part of that business actually improved. Management specifically highlighted signing 4 very large advisory deals.
Oh, interesting.
Yeah, described them as multi-year contracts, and they're building a stronger pipeline there, too. Seems like maybe a turning point for advisory.
So they expect that advisory piece to bounce back.
Big time. They're targeting double-digit growth in FY26, specifically over 25% growth for advisory.
Wow, that's aggressive.
It is. But they think that growth will largely offset declines elsewhere in software, leading to overall segment growth for performance services next year.
And how are they backing that up? Just hoping for deals?
No, they're staffing up. Strategically adding senior leaders, and they plan to add about 20 more people specifically for project work.
Okay.
And the key thing they mentioned is these hires will be deployed immediately, No significant ramp-up time needed, so they should contribute pretty quickly.
Right. Hit the ground running. Okay. Solid strategy there. So if that's growth, what about funding it and rewarding shareholders? You mentioned the strong cash flow. How are they deploying it?
Well, they've been disciplined, but also aggressive on buybacks. They bought back $800 million under that $1 billion plan that just expired in June.
Including an ASR.
Yep. Finished a $200 million accelerated share repurchase in August. Shows real commitment to returning capital, reducing the share count.
And dividends.
Still paying the regular quarterly dividend, 21 cents per share. Consistent payouts there, too.
Okay, now, you mentioned earlier the incredible cash flow. And I know one thing analysts were focused on was the Tax Receivable Agreement, the TRA payments finally ending. That sounds technical, but why is it such a big deal?
Yes, the TRA. It is a huge deal. Basically, these were historical payments they had to make, stemming from their IPO structure, I believe.
Okay.
And they amounted to about $100 million a year, a significant drain on free cash flow.
$100 million annually.
Yeah. And those payments stopped, completely stopped, on July 1st, 2025.
So starting this fiscal year, FY26.
Exactly. They suddenly have an extra $100 million in free cash flow every year that they didn't have before. It's like finding free money, fundamentally.
Wow. So that gives them massive flexibility.
Immense flexibility.
Yeah.
For growth investments like IllumiCare, more buybacks, dividends, debt pay down, whatever. It fundamentally changes their financial capacity and de-risks the balance sheet. It's a game changer for their long-term planning.
That is a powerful point. Okay, so beyond the financials, let's talk strategy shifts. Premier is clearly reshaping itself. What are the key moves they're making to, simplify and focus?
Right. They're concentrating capital on what they see as higher return core platforms. That means getting rid of distractions. Like the divestiture of S2S Global back in October 2024 and the planned wind down of Contigo Health by the end of this calendar year, December 31st, 2025.
And Contigo was losing money.
Yeah, for FY26, they modeled it contributing maybe $9 million in revenue, but losing $6 million on the EBITDA line as it winds down. So getting that off the books cleans things up. Strategic subtraction.
Makes sense. And on the addition side?
The key one is IllumiCare. They closed that acquisition in June 2025.
Right. You mentioned that. What's the strategic fit there?
It significantly boosts their ability to deliver real-time clinical insights right at the point of care. Uses AI capabilities. It fits right into their tech and data strategy.
And the financials on that deal?
Expected to add maybe $8-10 million in revenue in FY26. Be roughly break even initially, but they expect double-digit growth from it going forward.
And the value prop for hospitals?
They're touting a 10-to-1 ROI for customers, driving about $100 in savings per inpatient discharge. If that proves out, it's a strong offering.
Definitely. Okay, so putting it all together, the strong core, the advisory rebound hope, the TRA ending, the portfolio cleanup, IllumiCare. What does this mean for the outlook? What's the guidance for FY26? And maybe more importantly, what are they saying about FY27?
Okay, so FY26, they're calling it a year of stabilization and transition.
Yeah.
Makes sense of the Contigo wind down and finishing those GPO renewals.
Right.
So excluding Contigo, they're guiding to total net revenue between $940 million and $1.0 billion. Adjusted EBITDA of $230 to $245 million. And adjusted EPS between $1.33 and $1.43.
Okay. And you mentioned Q1 might be lower.
Yeah, they guided Q1 FY26 specifically, expecting it to be lower, especially in the first half. That's mainly due to hiring those advisory folks before the related revenue fully kicks in. It's an investment phase.
Got it. Investing now for growth later. So what about later, FY27?
That's where they expect a payoff. They anticipate a return to positive growth across the board, total net revenue, adjusted EBITDA, adjusted EPS, a clear rebound.
And what drives that rebound?
Several things. Increased software renewals coming up, the continued ramp, and they hope, sustained double-digit growth in advisory, getting synergies from IllumiCare integrated with their other tools, and crucially, much lower fee share headwinds. The drag is gone.
So FY26 is the transition, FY27 is the return to growth. That's the narrative.
That seems to be the plan they laid out, yes.
Now, zooming out a bit, Premier serves hospitals and health systems. We all know that's a tough space right now. What pressures are their members facing, and how does Premier position itself as, part of the solution?
It's definitely a challenging environment. Financial pressures are immense. You've got reimbursement cuts, ongoing labor shortages driving up costs, inflation on supplies. It's forcing health systems to rethink everything.
Right.
Premier positions itself to help with that transformation. The GPO obviously helps control supply costs through aggregated purchasing. That's fundamental.
Okay.
Their advisory teams focus specifically on operational efficiency, labor management, clinical variation, things that directly tackle those costs, and staffing pressures hospitals are facing daily. They aim for tangible savings.
And what about tariffs? Any impact there?
They addressed that, said their contracts are generally firm for the term, so they haven't seen hospitals panic buying ahead of potential tariffs. They try to manage that impact for members.
Interesting. And despite those pressures on their customers, Premier's stock has actually done really well, hasn't it, compared to the broader healthcare sector?
Yeah, it's quite remarkable. Over the past year, PINC stock had like a 31% total return. Meanwhile, the healthcare ETF, XLV, was actually down over 10%.
That's a huge difference. What explains that outperformance?
I think it really highlights the defensiveness of that GPO, the administrative fee engine. It's a steady cash generator, less cyclical perhaps than other parts of healthcare.
Right, that recurring revenue stream.
Exactly. So key things to watch now. Execution on those FY26 admin fee targets, how fast they wind down Contigo, more wins in digital health and co-management deals, and definitely any news on capital return now that the old buyback plan expired.
And if they keep delivering?
Well, the consistent cash plus more proof points in software and consulting actually gaining traction, that could lead to a real re-rating of the stock's valuation, especially given how choppy the rest of the sector is.
Okay, makes sense. Now let's shift gears slightly. Time for our This Is Not Financial Advice segment, a thought experiment for those with high conviction.
All right, let's have some fun. Given Premier's big strategic pivot, shedding assets, boosting core, plus that huge capital return, here's an idea.
Okay, lay it on us.
Imagine a highly leveraged, long-dated call option strategy. Think buying maybe 2027 or 2028 calls, perhaps in the money, like a $25 strike.
Okay, long-term bullish.
Right. But then maybe sell some out-of-the-money calls against them, same expiration, say at a $35 or $40 strike. Creates a bullish vertical spread, limits the upfront cost a bit, caps the upside, but defines the risk.
A leveraged bet on the transformation story playing out.
Exactly. The bet isn't just on that FY27 growth rebound itself, but on the multiple expanding significantly.
Why would the multiple expand?
Because the market might finally start seeing Premier differently. Cleaner story post-Contigo, higher margins potentially, more tech-enabled, constantly reducing share count.
Yeah.
And that $100 million annual TRA boost flowing straight to the bottom line or buybacks.
So it's not just growth, but a reperception of the company.
Precisely. Add in the optionality if that advisory business really takes off, and IllumiCare integrates smoothly, funded by existing cash flow. You could argue today's price is way too low if that all clicks.
So those far-dated calls.
Could be multi-baggers if they hit that FY27 inflection point and the market rewards the cleaner, leaner, cash-rich Premier.
It's definitely a high-conviction, high-risk thought, leveraging the transformation narrative. The bold idea indeed. Okay, let's bring it home. To recap, Premier Inc. closed FY25 strong, beat expectations.
Yep, set the stage for a transition year in FY26.
Right, with hopes pinned on a return to solid growth in FY27. They're actively reshaping, selling off some parts, buying IllumiCare.
Cleaning up the portfolio.
Yeah.
Focusing the strategy, while returning a ton of cash to shareholders.
And that advisory business seems key, alongside the core GPO strength. Plus, that TRA payment ending is a massive, massive tailwind.
Huge. So yeah, FY26 looks like stabilization, maybe a bit bumpy first half, but the underlying momentum in supply chain, the strategic shifts, that new cash flow capacity, it paints a pretty constructive long-term picture.
So the question for you, the listener, really becomes, do you believe this strategic metamorphosis can work? Can Premier not just navigate the tough healthcare environment, but emerge stronger and potentially reshape things a bit?
That's the multi-million, maybe billion-dollar question, isn't it?
It certainly is. Remember, everyone, this discussion was for informational purposes only. It is absolutely not financial advice.
Please do your own research. Talk to a professional before making any investment decisions.
Couldn't agree more. Thank you for tuning in to The Deep Dive.